February 24th, Monday. See that capitulation? That's when the market dropped 1,000 points. At the same time, that's when we saw the VIX index, which is our fear meter, was heading towards 30% right here. If it hit 28% to 30%, what would have happened is this market would have dropped another 1,000 points, okay? And the Fed knew that it would drop another 1,000 points. Now, why would it do that? Well, because what would happen is that the all of the big tech stocks that have been supporting this market, the Nasdaq since 2008, okay, has started to break down in November. See, there's the high, lower high is breaking down. It's gotten really weak. And if you remember what I said on January 16, 2018, when I forecasted that we're going to have a correction then, and I was right, 20%, that I said what's going to take this market down is going to be big tech stocks. And that's exactly what's happened. So the problem is they can't move these tech stocks up much because the government, the economy can't absorb the inflation that comes behind them, because the only way those have been going up for 14 years, okay, is because of quantitative easing. They were able to push them up for 14 years as long as they could keep buying treasuries. They printed 125 trillion to buy treasuries, keep yields down, to keep pushing up the tech stocks. They can't do it anymore because inflation's at a 40-year high. The economy can't absorb it. Powell turned around and he tried to switch and go back to banks, which were which were value stocks instead of growth stocks. So he thought, look, I could raise interest rates. The market certainly could take care of interest rates, absorb interest rate in the banking. Well, that didn't work either, because when you look at the banks, you see what happened here. The banks still see the downtrend with yields where they are now. We're almost at 200 basis points. We're just underneath a little bit. These bank stocks, okay, should be all the way up here by now. But there's so much resistance. See the downtrend? Okay? Because the problem is that they're saddled with houses that are 20 to 30% overpriced. That happened, remember, back here in 2020 when the market dropped. Powell panicked and he bought treasuries to drop the yield from 155 down to 81 basis points. People went nuts, came in buying houses, and they were getting rates at 2.3, 2.33. That's what drove the whole crazy housing market up. So the housing market as of today, because of those low rates, are 20 to 30% higher than they should be. And that reflects into the banks, because that's why these banks, even though yields are high, when you get yields over 150 and we're almost at 200 basis point, the banks love it. And these should have been all the way up here in the trend. Should be going up like this, not down here. So they got a serious problem with the banks. The economy can't absorb the high rates, and they got a problem with the economy can't absorb the inflation that is needed to push up the big tech stocks. That's why you saw what happened with the S&P, and this explains why the S&P on this Monday right here had this big capitulation. Then we had another one and another one and another one. Okay, the market tried to fall 4 more times, Monday, Tuesday, Wednesday, Thursday, and the Fed stopped it. Okay, but they can't keep doing this forever. And let me tell you why, because they're going to start raising rates in March on the short-term stuff, which is your car payments and auto loans and all that. That's not going to work. Now that what's going to happen is when they start raising the short-term Fed rate, that's going to affect payments on all your payments. Like I said, student loans, car loans, small business loans, home improvement loans. People can't afford that. They can't afford that. And then on top of that, he's going to raise yields on the 10-year Treasury. So home mortgages aren't going to be at 2.22%. Remember when we had that big rally in the housing market where we shot straight up, where price of homes went 20-30% within 4 months, and they're still hanging in there. Now he's going to raise the long-term rate, which that means the 30-year fixed-rate mortgage is going to go through the roof. And what's going to happen? The whole market's going to collapse. Okay, so that's where we are. That's why this is so critical to remember, and also watch this here. If the VIX index, this is the fear meter. When this gets up towards 30, closer to 30, remember what's going to happen. Okay, the market will collapse. That's why they came in and stopped the market from collapsing that day, and we had 1,000-point, 1,250 turnaround that day. And then the next day, we had another one. All week, every day, we had these turnarounds. So now what's going to happen is the market only has one place to go, is down, okay? So they're doing everything they can to hold it above the 200-day moving average. So next week, what we're going to do is see what happens as these yields keep going up, okay? And so with the threat of the yields going up, you're starting to see people sell more and more stock, and you're going to also see this trend. See, it's not changing. Even though we had a couple moves in the stock in the last couple of days. Look, it's not doing anything. That's the spiders here. Look at the Qs. Look at this. Terrible. Look at that. So we had a couple, but remember, we went up. Now she's pulling back. Okay, even though it went up a little bit today, look what's going on with this trend. So the Qs are breaking down, the spiders are breaking down, and the banks that should be taking off and rocking, they're not. Okay, J.P. Morgan, XLF, the ETF, this thing should be already up here by now. Okay, but all these banks are having trouble because again, when remember the yields are great for banks, and we buy bank stocks, okay, when the yields are high like this. But we're not buying them because, again, see the trends? If you take XLF, see how we have a downtrend here? If you buy in downtrends like this, okay, you can get a swing trade like we did this week. Like if you buy a swing trade here, right, you get 2, 3, 4 days, but it's not going to last. It's going to come because of your downtrend. Until we break these downtrends like this, we have a high probability of the crash will finally continue. The crash will take out these lows. That's what we're looking for. When will it take out these lows? Will it be in March when they start raising the short-term rates, or will it be when they start raising the mortgage rates? Okay, we don't know. So everything's on hold right now, and I'll go over this on Monday in our class again, okay? So that's where we stand. So I told you it was a year now since I started this, and I said we're going to have a crash. I said that in 2018, and this is we're in it, really. They just stopped it, okay? And you can see why they stopped it. They got scared off with that VIX up here. They thought, they're going to dump $75 billion worth of product, and we only have $5 billion to absorb. And that would have caused a horrific crash. Okay, I will see you on the charts, and please remember, okay, to